Okay, guys, so in this video, we're going to talk about 10 recession-proof stocks to buy for 2020. So these are 10 companies that I found during my research that have actually performed fairly well throughout the whole global recession and slowdown. So guys, if you're looking for companies that can provide some good returns, as you know, we're definitely going to be continuing in a recession, probably throughout 2020 and even maybe into 2021 if you're kind of looking back into 2008. Last time we had a major financial collapse in the United States, the recession lasted about 18 months, so about a year and a half. So since things started turning sour in the early of 2020, I would say we'll approximately be out of this situation probably somewhere time mid through 2021 if you use the 2008 Great Recession as a past example. So let's get right into it, guys. My list of 10 recession-proof stocks and investments to strengthen your portfolio during a tough times. So number one is Walmart. So for me, Walmart is kind of the de facto stock that I want to gravitate towards during a recession simply because people are going to continue stockpiling items like food and clothing and things like that. And Walmart is a very consistent business. So as you can see here, Walmart is simply a member of the S&P 500 Dividend Aristocrats Index, and they have raised their dividend for 46 consecutive years. So if we take a look at their dividend yield, they're paying a dividend of 1.75%, which is very solid, very consistent. So it's quite a nice dividend stock to add to your portfolio. And let's take a look at what it's done so far year to date as of now. So as we can see here, while many stocks have actually underperformed, as we see here, the Morningstar US overall market is down 12% year to date, while Walmart is actually up 4%. So this is one of the few companies out there that has actually done better in this tough recessionary times, as people are obviously going to be gravitating more towards discount stores and buying things. They're going to be very, very price conscious and price sensitive. So all of these expensive retailers with their price margins jacked up and things like that, people are going to be gravitating towards Walmart. Okay, so now taking a look at Walmart's year-to-date chart, it's done pretty well. And like I said, Walmart for me has always been a consistent performer. I do own Walmart stock in my retirement account. And as you can see here over the long-term chart, Walmart has basically gotten through every major crisis, whether it was the dot-com bust, the 2008 Great Recession, and the crash of 1986. So Walmart is a very consistent stock. If you guys are looking for one stock to add to your portfolio for the long term, for like your retirement or something like that, I think Walmart is a very, very strong play. And the fact is, you're going to get consistency with Walmart as well. So like while you're not going to get massive compounded annual growth rates like you would with Netflix or Tesla or something like that, you're getting around 10% per year. That's not including the dividends. So if you include the dividends, around just about 11 to 12%, and over the last 15 years, 7.82% plus that dividends are around 9%. So somewhere around between 9 to 11% annual per year based on the past. And like I said, Walmart is always in play. People will definitely be leaning towards Walmart in America when they're buying goods. Okay, so number two on the list is Apple. So now a lot of people have been talking down Apple and hating on it, saying that people will not be buying their high-priced electronics during a Great Recession, and I'll have to disagree. So if we take a look at the past, obviously the past is definitely a window into the future. So during 2008, the company increased revenue 65% year over year compared to 2007 and continued to chug along while other tech companies suffered falling sales. So one of the things about Apple is that even in a recessionary period, people are still going to be using smartphones, still going to be using computers, and they're still going to be buying things with Apple Pay and also listening to music. So Apple is not just a phone company now. They're very, very diversified tech conglomerate, and they have lots of different products, and they're always innovating and things like that. So I also talked a big about how they have a lot of new products coming out for their product line. So I posted a past video on Apple, so you could guys check that out for more in-depth information there. But one of the biggest biggest things they're coming out with, new technology, is the Apple iPhone SE. So Apple has never done this before. It's their first discount smartphone. It's selling for under $400. And basically, this phone is going to open up their services revenue a lot. They basically took an iPhone 8 body and then combined it with iPhone 11 up-to-date software and a camera like that. So basically, they made an awesome phone for a very low discount price, and that's going to basically take away a lot of business from Android users who are basically only buying Android phones due to the price. So now with that, now with basically, which is considered maybe the biggest deal in tech, a lot of consumers now are going to have to choose, do I even want to deal with Android, or should I just get the lower price iPhone? So that's a Okay, so that's a great, obviously, option for Apple, and of course, the company pays a 1.12% dividend, and they've been paying the dividend for around 7 years. They've been paying a dividend for around 7 years. And one of the nice things about Apple is while most companies have halted share buybacks and dividend increases, Apple has actually announced another $50 billion share buyback program, and they increased their dividend by 8%, guys. So let's take a look at some of the things on Apple. Okay, so as you can see here, year to date, Apple is just down Okay, so as you can see here, Apple shares are down just a slight tick, 1% year to date, while the overall market is down around 12%. And I still think Apple has one of the best long-term compounded annual growth rates out there, 31% over the last 15 years. So if we take a look at the Apple chart, we can see that year to date the stock has basically been flat, and one of those reasons is that simply Apple has performed very well in Q1 of 2020. So a lot of investors realize that Apple is a very strong and consistent company. They've been through all of these crises. They've been around for a long time. If you take a look at the long-term chart here, they've survived all of the crises in the past and have returned a lot of long-term value for shareholders. So Apple is also the number one holding for Warren Buffett's Berkshire Hathaway, and I actually have a decent stake in it as well. And like I said, when in doubt, you can rely on Apple. I think they've proven themselves over the last couple of decades, and even though the company has obviously grown a ton over the years, I still think there's a lot of growth ahead. More with 5G coming up, more and more people are going to be able to download videos and play games at much faster speeds, and that should do very, very well for Apple's service revenue, and of course things like music and Apple TV. And Apple just has so many different products that they'll be able to capture revenue and increase their earnings regardless of the environment, in my opinion. Okay, moving on. Okay, so third on this list is Coca-Cola. So now, why do I like Coca-Cola? Well, I think Coca-Cola is one of those stocks where people aren't going to stop drinking things no matter what's going on. So Coca-Cola, obviously, they have a very, very diversified product line now. They're not just soda. They have juices, they have water, they're working on different types of teas and stuff like that, and they have many different beverage lines under the Coca-Cola brand. So I think it's one of the most stable companies, but the only thing that is that a lot of Coca-Cola's revenue does come from things like restaurants, movie theaters, and sporting events. So their revenue is definitely temporarily affected by the whole coronavirus situation. But a good thing is that in Q1, consumers started stockpiling drinks, so that kind of helped their earnings and their revenue as well. But they did withdraw guidance in 2020 because social distancing negatively affects their sales. But the good thing is that a lot of places in America have been opening up in May, and I expect the rest of the world to follow suit in May and June. So we should see an absolute surge in people basically buying drinks and things like that, because people are definitely itching for socialization after basically being cut off for a couple of months. So okay, so of course, Coca-Cola is good because it's a member of the S&P 500 Dividend Aristocrats Index, just like Walmart, and they've increased their dividends for 56 straight years. So at a current yield of 3.6%, I think Coca-Cola is an excellent recession-proof stock that can actually not only give you some capital appreciation, but can put some dividend income into your pocket. So if you guys are looking for some stocks to have in your retirement account or something like that, or you simply want to build a dividend growth portfolio, I think Coca-Cola is an excellent choice. Okay, so Coca-Cola is one of the poor performers so far year to date. But remember now, a lot of that was due to the social distancing measures of the coronavirus. So that will they'll end soon. Obviously, a lot of governments are already opening things up. China's been open. America is basically opening up. So a lot of I think Coca-Cola will make back a lot of those gains that they have lost. And even as long as the recession lasts, let's say until the midway through 2021, I think Coca-Cola stock will bounce back pretty nicely. So if you take a look at the 15-year compounded annual growth rate around 7% plus that 3% dividend, Coca-Cola stock is basically returning you around 10 to 11% annually. So it's a lot safer, I think, than a lot of other investments. And like I said, people aren't going to stop drinking anytime soon. So if we take a look at Coca-Cola stock chart, yes, it is down 16%. But if we take a look at the long-term chart, we can see that Coca-Cola has done very, very fine for investors over the long term. So you're up a ton if you invested in Coca-Cola. And like I said, it's one of those, it's also another Buffett approved company. Warren Buffett is actually the largest shareholder in Coca-Cola. He has about 400 million shares. So, I mean, investing with Buffett, it's hard to go wrong. The man is turning 90 years old this year and is one of the most successful investors of all time. So I think Coca-Cola is another solid recession-proof stock. Okay, moving on. Okay, so playing on the same theme as Walmart, I'm kind of leaning towards companies that basically people are going to be shopping at no matter what. So another one is Costco. So Costco is a little bit different from Walmart. They basically cater towards the same market. They're a discount big brand retailer. They sell lots of things like food and clothing and stuff like that. But Costco is a little bit different because they actually sell a membership. So you cannot shop at Costco unless you have a membership. And basically, during the 2008 Great Recession, revenue increased 8% and basically remained flat in 2009. So the company wasn't really affected by the last major recession, and they've even expanded to China, where they have a ridiculous demand over there. So people are going to shop at Costco. People are basically going to be taking any money they have and making sure they have basic food and basic clothing. So that's why I like Costco stock. I think it's another safe play. And Costco just recently increased their quarterly dividend by 8%, and they've raised their dividend for 16 straight years. So I think it's a pretty much another safe play as well. And it actually is a more aggressive grower than Walmart. So let's take a look at those trailing returns in the stock. Okay, so as you can see here, I'll take a look at Costco year to date. They're actually up 3% while the broader market is down over 12%. And over the last 15 years, they've returned about 15% compounded annual growth. So I also mentioned that Costco does pay a dividend as well, a 1% dividend yield. So if you're wanting to choose between Costco and Walmart, Costco's probably has more value basically because it's a lot smaller and it has more room to grow in the future. But for me, I know what I'm getting with Walmart, so that's why I prefer Walmart. And as you can see here, over the long run, Walmart and Costco have a similar chart. Basically, these companies are continuing to grow, people are continuing to shop, and they continue to open more stores. And they can raise prices with inflation, which makes them a great recession-proof company because, as you know, people are not going to stop buying food and clothing. So these basic essential stocks are some of the best stocks I think you can buy in this type of environment. Okay, so moving on. Okay, so number 5, Dollar General. So like I said, I'm going to keep this basically staying with these stores like Walmart and Costco and things like that, these big retailers that sell food and clothing, because this is exactly where people are going to be spending what income they have. So Dollar General is a little bit different than the other two. So Costco and Walmart, they basically focus on big markets like big cities and things like that. Dollar General is the opposite. They focus on smaller towns and cities within middle America, and they're actually the fastest growing retailer in the United States. So they've been doing extremely well over the last couple of years, and they've increased their revenue 15 years in a row. That's including through the 2008 Great Recession, and the stock is up actually 12% year to date, and the company does pay a dividend as well, although the dividend isn't as good as Walmart or Costco. So let's take a look at the Dollar General, some of the numbers there, and I think they're a really nice play if you're looking for a very, very fast growing company that is going to be making a lot of money during this recession. Okay, so as you can see here, Dollar General is actually up, ticker symbol DG. It's actually up 11% year to date, while the broader market is down 12%. And over the last 10 years, they've returned 20% compounded annual growth rate. So, guys, pretty solid company here. A lot of people don't know about Dollar General, but there's a lot of value here, I think. Okay, as we see, if we take a look at the year-to-date chart, it's up around 10 to 11%, and over the long term, Dollar General has done extremely well. So this is one of those other kind of faster growing companies. So if you guys are looking at probably the fastest out of Dollar General, Walmart, and Costco, I think Dollar General is your best bet. This is another stock that I'm seriously considering adding to my portfolio as well. Although I have Walmart in my retirement, I would probably add Dollar General to my general individual portfolio. Okay, so moving on. Number 6 is Ross Stores with a dividend yield of 1.25%. So kind of continuing this trend of discount retailers. Ross Stores is one of America's leading off-brand discount retailers, and one of the things about Ross Stores, they're a little bit different from Costco and Walmart, and who sell things online. So since obviously most of Ross's stores had been closed through most of March and heading in most of March and April as well, their sales are going to be affected. But I think during a recession, definitely Americans are going to flock to the cheaper prices to save money. So the good news is during the 2008 Great Recession, they did increase their revenue, and the company does pay a stable dividend. So let's take a look at the return. So back on Morningstar, as you can see here, the stock has been crushed quite a bit this year because obviously of those store closures and the lack of online sales. But I think it's going to bounce back quite nicely, and the stock has still returned 19% compounded annual growth rate over the last 15 years. So I think there's a lot of value in Ross stock, and it's actually a stock that I really like. And if you take a look at the year-to-date chart, there's definitely an opportunity to buy this stock at the long term. You can see that things were moving quite well up until this temporary global stay-at-home order. So other than that, the company had been chugging along just nicely and had, done well in the previous recession. And actually, a lot of people will probably start shopping at Ross now to save more money because you can get a lot of designer brands at a much cheaper price. So I think Ross is a great recession-proof stock. Okay, moving on. Okay, guys, so number 7 on the list is AT&T. So I own AT&T stock for its massive dividend yield. It's one of those other recession-proof stocks out there. And one of the reasons is that a lot of AT&T shareholders don't really plan on selling their stock. They simply hold it for the dividend. So the company actually grew revenue in 2008 during the Great Recession. And like I said, people are a lot less likely to cut cell phones and internet during a recession since, communication is one of the last things that people will get rid of. So obviously that DirecTV acquisition was not a good idea, and that was probably taking a lot of focus off of their core revenue streams because more people are moving towards streaming content anyway, and owning something like a cable type company isn't a great investment. But the good thing is that they still are a member of this S&P 500 Dividend Aristocrats Index, and they've increased their dividend for 35 straight years, guys. So AT&T, another consistent clog in my retirement portfolio and another nice recession-proof stocks. Let's take a look at some of those numbers. Okay, so AT&T is another stock that has been beaten down quite a bit, and I think it's a little bit of an irrational sell-off for AT&T because they're actually very shielded against the recession, in my opinion. People are going to keep their cell phones. So, the returns obviously aren't as great on AT&T because most people are owning this stock for the dividend. But over the last 15 years, it's returned almost 6% compounded annual growth rate plus that 6% dividend. So you're looking at about 10 to 11 consistent percent return over the long run. So if we take a look at that year-to-date chart, we can see that shares are at a nice discount. And if we take a look at the long run here, we can see that AT&T stock has done just fine for shareholders. So guys, it's one of the things I'm trying to focus on when I look at recession-proof companies. I'm trying to think long-term. I'm not trying to focus just on the short term, because these recessions will end and things will bounce back sooner than we expect. So it's just a good idea to identify strong performers over the long term. Okay, so number 8 is Netflix. So Netflix is another stock that continues to chug along, and this stock was actually the biggest winner in the whole coronavirus situation, although you could arguably vote for Amazon as well. But the fact that the company gained 15 million subscribers in Q1 2020 shows that even with people not going to work and things like that, they were staying at home watching a lot of Netflix. So Netflix has increased their revenue for 15 straight years, and anytime I think that Netflix, is going to slow down or they're not going to be able to grow, they continue to prove me wrong. So this is actually one of the stocks on the list that does not pay a dividend, but Netflix has such a crazy high compounded annual growth rate over the last 15 years that you're still making money with your investment, but you're not getting a dividend. So let's take a look at those numbers. Okay, so Netflix has been a huge winner this year to date, up 28% versus the overall broader market of 12%, and a 44% 15-year compounded annual growth rate, guys. So Netflix stock has been one of my best performers by far. I wish I had bought a lot more. As you can see here, the stock has been just on a tear, a pretty big year to date, and over the long term, Netflix has been an amazing performer. So absolute tear. It was actually the best performing stock of all between 2010 and 2019 over the last decade. So Netflix will just continue to chug along. They'll continue to grow their subscribers, and 5G is a big boon for Netflix. It'll just make it so much easier to watch high definition video. So that should send the stock price to 500 and beyond, in my opinion. Okay, guys, moving on. Okay, so number 9 is Match Group. So this is probably a stock that a lot of people aren't familiar with, but you're probably familiar with Tinder, the most popular online dating app, unless you've been living under a rock. But anyway, so will people stop looking for love during a recession? Probably not. So actually, Match Group owns Tinder, the world's most popular dating app, as well as other apps like Plenty of Fish, Match.com. There's quite a few they own. OkCupid. Well, anyway, after successfully completing a spinoff from IAC, I think Match is the best way to invest in the accelerated online dating trend. And last year in 2019, Tinder alone brought in over $2 billion in revenue, and people won't stop looking for love even in a struggling economy, in my opinion. So let's take a look at those numbers. Okay, so year to date here, only, down about 9%, which is better than the overall broader market, as you can see here. But over the last 3 years, the company has returned 58% compounding annual growth. And this Tinder app is the real deal, guys. This was actually the highest grossing app in 2019. That's right, Tinder, that made more money than any other app on the Google Play Store. So a great stock to buy. And like I said, if you want to invest in the online dating industry, I think Match Group is your best stock to. Okay, so we look at the price chart here. The stock is down about 10% year to date, but at $74, I think it's a pretty solid price. And if you take a look at the long-term chart, we can see that this stock has been on a tear, and it's only been public for a couple of years. It just spun off around 4 years ago. So I'm really excited for this company. I think a lot of people are definitely using online dating apps, especially millennials, but they're not thinking about buying the stock. So for you guys out there using Tinder, make sure if you're using Tinder a lot, you actually own the stock as well, so you can get some of the money back that people are spending on this Tinder Gold and all stuff like that. Okay, guys, so moving on to the last. Okay, so wrapping things up, the last stock is Shopify. So this is a little bit probably the riskiest stock on the list of and all of them, but I love this stock. It just keeps going up basically. So this Canadian online e-commerce company is one of the fastest growing stocks in the New York Stock Exchange and should survive the upcoming recession with ease. So there is a bit of risk here because maybe people spend less money, but there's kind of a inverse relationship because as more and more people get furloughed, lose their job, get laid off, they might perhaps try to start their own online business. And Shopify makes a lot of money with monthly subscribers. They charge you a monthly fee to run a online store on their platform, and they just passed 1 million paying subscribers. So it looks like the stock is headed a lot higher. So guys, Shopify is another stock on the list that does not pay a dividend, but you're getting a lot of fast growth, actually hyper growth with this stock. So let's take a look at the numbers. Okay, so Shopify stock has absolutely crushed the overall broader market, up 54% year to date, while the Canadian broader market is down 13%. And over the last 3 years, a compound annual growth rate of 99%, guys. So basically, you're doubling your money every year you've owned Shopify stock since it's gone public. So let's take a look at that chart, and I want to wrap. So as you guys can see here, the stock is up big year to date, and over the long term the stock has absolutely been crushing it. So okay, and as you guys can see, over the long term Shopify stock has absolutely been crushing it, and I love their business model. I love that recurring revenue that they get from subscriptions plus transaction revenue. So during this whole lockdown, I read reports that said Shopify was experiencing Black Friday traffic every day across their servers, guys. So this stock could be headed to 800 or 1,000 by the end of the year. A lot of people who don't know about Shopify, there are lots of actually people. In fact, Kylie Jenner became a billionaire using Shopify software. Also, Rihanna with her Fenty line, she uses Shopify as well. So a lot of celebrities out there are using it just like average Joes to make money online, and it makes it really easy to create a store. I just want to wrap things up with Okay, so I just want to wrap things up this video with a full disclosure. I do own shares of Walmart, Apple, Coca-Cola, Netflix, Match Group, and AT&T. So guys, I hope you enjoyed this list of the 10 recession-proof stocks to buy, to make a lot of money and strengthen your overall portfolio. So let me know what you guys think about my list in the comments section. Be sure to give me a thumbs up if you enjoyed this video, and hit that red subscribe button to receive more updates. I post videos every day on the stock market. So I hope you guys enjoyed this video. Until next time, take care.